S&P 500 opening above 5,000 this morning. Earnings, especially from mega caps, bringing the index higher, but there might be danger in being overexposed to big names. For more on this, we've got Joe Mazzola, who is the Charles Schwab Director of Trader Education here. Joe, great to see you here this morning. When we think of some of the new highs that we're looking to strike at today's close and where we've been trending to get to this level, what does that set up for investors that are trying to figure out how to position their portfolio off of highs?
Yeah, I mean, round numbers are a real thing. I would look at this a couple ways. I would look at this from sentiment indicators, but I'd also look at it from, the concentration of the move. So, our own sentiment indicator that we have, we call it STAX. That's the Schwab Trading Activity Index. That showed that our retail investors were, moderately bullish in January. So we basically track over 30 days, 35 million accounts, and then we create an index, and the score, if it goes up, that shows that more activity on the bullish side in client accounts, and we did see that. It's nothing glaring. It's nothing that would suggest that there's this fear of missing out type of trade, but it does suggest that there was some positive sentiment, and it's a bullish indicator. And I would also say that from that perspective, where were clients moving their monies into? Well, I mean, it's kind of what you're seeing in the overall market. There was a lot of concentration towards the Mag 7. So, you saw some buyers of Tesla, Nvidia, Amazon. Those were the three biggest buys. And, where did they sell? They sold in some of the interest rate sensitive sectors. And so the same transition that you're seeing going on in the market right now that really started in into December, into January, where there was a realization that, well, we're not going to get maybe those 5 to 6 rate cuts we were hoping for. It made its way into our own clients' trading activity, where they decided that they wanted to kind of stick with maybe some of the game plans that worked in 2023.
Joe, in terms of what you're hearing from many of your clients right now, yes, there's a lot to be excited about. We have the S&P just above that 5,000 level, but there is a heck of a lot of uncertainty. And even just looking ahead to next week, when it comes to those CPI and inflation prints that we're going to be getting, what is the biggest concern that you're hearing, or biggest worry from clients, and how are they then hedging some of those bets?
Yeah, that's a great question. So what we're kind of hearing is, there is a little bit of concern about maybe some of the concentration, even though, they are kind of moving into those different positions. What we notice is from that score that I mentioned, it's a 44.73. Now, if you look at the range on that, and that's kind of moderately low. So what you're seeing is clients are buying, but they're not levering up, because we look at the levered ETFs, we look at option activity, we look at all of that in there, and apply kind of like a beta to that. So, the more that they're levering up, the higher that number would be. So I think that there's this cautious optimism, but there's also this belief that, what's going to happen once these rate cuts kind of start? You guys were just talking about the buy the rumor, kind of sell the news. Is that same thing going to happen in the market once the rate cuts start, as we move into what we're predicting May? And the rate cuts when they commence, and about 3 to 4 for the year. And in terms of how are they looking to hedge some of that downside risk, I would say this. I would say from the market as a whole, one of the things that concerns me is the lack of hedging. We're not seeing the same type of hedging you would start to see at normal market tops. If anything, there's a little bit of complacency in some of that upside call buying. What I've been telling some of our clients and investors, if they are concerned about that, there's different ways that they can handle that. One way would be, maybe trimming some of those long equity positions and rotating into like call spreads or covered calls, because of the fact that the call premium, the call skew relative to what people are paying for puts, it's higher. Right now, it's about the 5th percentile, meaning 95% of the time it doesn't trade at these levels over the last 4 years. So, it's noticeable.
Joe, we've got a whole Super Bowl and then a whole NBA All-Star weekend. We've got all these events until the next job sprint. If we get another hot job sprint, what does that signal for how the Fed may evaluate this entire rate cut situation and what investors should be prepared for?
Well, it's interesting because, the whole mantra over last year was, good news for the economy might be bad news for the market, right? Because you're not going to get the Fed rate cuts that you were hoping for. But we started to see a little bit of a shift in that in the last month or two, where good news became good news. And we're starting to see, even though interest rates are climbing up, the 10-year yield's about, 4.18 right now, you're still seeing the market push towards highs. Maybe investors are starting to digest that information and just say that, yeah, you can still have good economic prints at these levels and the market can handle that. I would say that next week's CPI and PPI data are really important numbers, because if they come in hot and way above expectations, that could be something that could definitely stall this rally.
You can still have good news and have new all-time highs. Joe Mazzola, Charles Schwab, Director of Trader Education. Joe, thanks for taking the time here today.
Thanks so much.